Welcome back to John Orfer's Note. The sun has appeared to be setting on global bond markets. We've seen quite a sell-off and yields rising, especially in emerging markets. But what does it all mean for those sunnier but also sometimes riskier countries in southern Europe, which were at the heart of the eurozone crisis? With me to discuss this is Laurence Mutkin, who's the head of rate strategy at Morgan Stanley. Laurence, the sell-off across bond markets around the world has been quite pronounced. On our first chart, we've selected a few. Tell us, though, what's happening in southern Europe.
Well, what you can see is that indeed yields have risen in Spain and Italy as they have everywhere else.
That's the yellow and the green lines, yeah.
Indeed. But perhaps it's worth noting that this has not been about Spain and Italy. This has been about what's been going on in the US primarily, where the Fed, of course, has moved to discuss the beginning of removing the accommodation through tapering its QE.
Right, okay, it's not a crisis in the eurozone this time.
Exactly not. And in fact, although all yields have gone up, you can't see it terribly clearly from the chart, but you can see that Italy and Spain have in no way outpaced other asset classes.
That jump right at the end.
Yeah.
Interestingly, you put on this chart corporate bond spreads as well. How's Spain, Italy doing against, these are investment grade, so they're better companies, I guess.
That's right, but against generally spread product, Spain and Italy have held in better. So investment grade corporates are on here, but if you had high yield corporates or emerging market debt or local currency emerging market bonds, you'd see that those had actually underperformed both the sell-off in core rates, but also the sell-off in peripheral rates.
Well, why is it that Spain and Italy are not doing so badly, are just moving with everyone else this time? I mean, in the past, when we've had crises before, as we can see, they've shot up. Has something changed?
Well, very much so, and I suppose it all goes back to last summer's whatever it takes speech.
From Mario Draghi.
From Mario Draghi. And you can see that prior to that, in 2011 and 2012, it was Italy and Spain whose yields were rising, and certainly from the end of 2011, every other yield was falling. And that was really about the market suddenly becoming mistrustful of whether Spain and Italy were really, as you would say, government credits or duration assets, or whether they were just declining credit markets. And I think what we've had since the middle of last year is that the market has taken on board what Mario Draghi said and is gradually bringing Spain and Italy back into the fold, as it were, of proper government bond markets.
I wonder
in Europe.
if there's perhaps a less benign explanation that actually investors were piling into corporate debt, into emerging markets, and less so into Spain and Italy, so they had less to fall, if you like, or yields are less to rise.
Well, I mean, I think part of what the Fed was trying to do with quantitative easing was to push investors into markets they wouldn't normally be in. This is called the portfolio transmission mechanism or channel. And of course, now that channel's going back. But as you say, the markets they went into were not eurozone peripherals.
Let's turn to our second chart. We've plotted the unemployment rates in the eurozone and in the US, and what we see, of course, is a big divergence between the eurozone still going up and the US falling.
Well, that's absolutely right, and you can see here very clearly the reason for the divergence between what we now expect from the Fed and what we expect from the ECB. The Federal Reserve sees gradually declining unemployment, is looking to the 6.5% level, at which point it can move further away from this extraordinary period of quantitative easing, whereas the ECB is still confronting very weak growth, rising unemployment, and is therefore, we expect still going to cut rates from here.
So cut rates. I was going to ask you what the options are for the ECB. I mean, it's in fact seen a monetary policy tightening whilst unemployment's still rising.
Well, it has seen a repricing of bond markets, but I don't know how huge that repricing has been in the scope of an overall interest rate cycle. Nonetheless, it's certainly going the wrong way, and certainly the ECB still has, at this point, the option to cut the refi rate, the main rate, which we expect them to do during this quarter, and still to go towards negative deposit rates, again, by the end of this quarter.
Part at the ECB. What about more liquidity? They're quite well known for their 3-year long-term refinancing operations. More of those?
I think they would say nothing is off the table in terms of unconventional policy even now.
Laurence, thank you very much. So we may be seeing the sunset over bond markets, but it's difficult times for the Fed, possibly even more difficult for the European Central Bank.